All right, so here we are in exercise 21-3B. Again, we're accounting for lease from the point of view of the lessee. In this particular case, the sort of different twist that you see in the problem that you haven't seen so far is the issue of executory cost. Executory costs are simply costs that are incurred in connection with the leased asset over the lease term. And typically it relates to things like repair and maintenance cost, taxes on the property, if there are any property taxes due, insurance on the to insure the leased asset against some sort of catastrophic loss. It's sort of the recurring cost that you have in connection with any sort of asset that you use in connection with your operations. The key point is sometimes lease payments stipulate that a portion of the lease payment is for executory cost. And when that is the case, you have to pull those executory costs out when doing the present value calculation because they are not considered to be a component of minimum lease payment. Okay, so here we are. We've got Yard Waste Corp is the lessee. They enter into a lease agreement on January 1st, 2014. And the lease term, so we've got a 6-year lease term, and we're leasing a mulching machine. And so the lease agreement requires rental payments of $81,680, so that's the rental payment amount. And the rental payments are made at the beginning of each year. So we signed the lease on January 1st, 2014, and on the day that we ink the contract, we have to make a payment on January 1st, 2014 of $81,680, our first lease payment. So what that tells us is that in our present value calculations that this is an annuity due problem because the payments take place at the beginning of the period rather than the end of the period. Okay, so the fair value of this machine is $400,000. The machine has an estimated useful life of 10 years. So we've got a 10-year economic life. And we have a 6-year lease term. Okay, so what else we got? We've got residual value of $35,000, but that residual value is not guaranteed by the lessee. Let's see. Our lessee depreciates its equipment on the straight line basis of accounting, so we'll have to take that into account when we book depreciation expense. The lease is non-renewable, and at the termination of the lease, the building goes back to the lessor. So the significance of that, it tells us that the title doesn't transfer to the lessee. The title of the property remains with the lessor. The lessee's incremental borrowing rate is 8% per year. The lessor's implicit rate is not known by the lessee. So the significance of that, if the lessor's implicit rate were known by the lessee, and if it were less than 8%, then the lessee, in doing the present value calculations, would use that lesser implicit rate. But since the lessor's implicit rate is not known, in doing the present value calculations, the lessee is going to use their incremental borrowing rate of 8%. And what we're told here is this $81,680 recurring rental payment includes executory cost of $1,563.19, and this relates to insurance on the machine. So this $1,563.19 is not going to be considered part of the minimum lease payments when we do our present value calculation. So we're going to have to subtract that $1,563.19 out of the $81,680 recurring rental payments when we do our present value calculation. Okay, so we're asked to prepare the journal entries here for in the lessee's accounting records for the years 2014 and 2015. Okay, so first thing we need to do is we need to figure out whether this is an operating lease or capital lease from the point of view of the lessee. And so to do that, we apply our four-part test. And the first question to ask is whether or not there's a bargain purchase option in connection with this lease. Again, a bargain purchase option is an option that is granted to the lessee that allows them to purchase the property at the end of the lease term at a price less than the fair market value of the property. There's no indication that that's present here. Next question to ask is, does the title to the property transfer from the lessor to the lessee? And the problem here specifically told us right here in item 4 that at the termination of the lease, the building reverts back to the lessor. So that's basically telling us no, the title does not transfer to the lessee at the end of the lease term. So no title transfer. Next question to address is whether or not the lease term is at least 75% of the economic life of the asset. Now the lease term here is 6 years, and the economic life of the asset here is 10 years. So the lease term as a fraction of the economic life of the asset is only 60%. Clearly 60% is less than 75%, so the answer to the question of whether or not lease term spans at least 75% of the economic life of the asset is no. Okay, I've got a bunch of markups here. Let me clear these out before we proceed to the next part of the calculation, or the next part of the four-part test, rather. Okay, the last question to address is whether the present value of the minimum lease payments are at least 60% of the fair value of the asset. And the answer to that question, as we'll see below, is yes. Since we answered yes to one of these at least one of these four-part test questions, we met one of these criteria. So the conclusion is that this thing is a capital lease to the lessee. Okay, so let's show now the calculation of the present value of the minimum lease payments. So here is where we calculate the present value of the minimum lease payments. So we've got, remember, minimum lease payments can consist of 4 components. The recurring payment amount, which excludes executory costs. We have any guaranteed residual value, that's a component of minimum lease payments. We have bargain purchase option, that can be a component of minimum lease payments. And any non-renewable penalty, that can be a component of minimum lease payments. In this particular case, we only have one of those components. We have the recurring payment amount. Although we have residual value here of $35,000, that's what the asset is expected to be worth at the end of the lease term, that residual value is not guaranteed. Since it's not guaranteed, that residual value is not a component of minimum lease payments. Minimum lease payments only includes residual value if it is guaranteed by the lessee. Okay, so what we need to do is we need to calculate, in calculating present value of minimum lease payments, we basically need to calculate the present value of the obligation of the lessee to make 6 lease payments of, okay, now the lease payment amount, $81,616, we need to subtract from that $81,680 the portion that is considered executory payments. $15,6319 is considered executory payments. So the net of those two amounts, I don't have that number at my handy disposal here. Oh yeah, I do. It's 80,116.81. That is the portion that we're going to calculate the present value of here. So what we're going to do is we're going to, again, take the full payment amount of $81,680, subtract from it the portion of the payment that's considered executory cost. The net is $81,681, and we're going to multiply that $81,681 times the present value of an annuity due factor, where n is equal to 6 and the interest rate is equal to 8%. Again, annuity due because the first payment occurs on the day in which we enter into the lease term. That annuity due factor is 4.9927. So if you take the payment amount net of executory costs, $81,681, multiply it times the 4.9927 annuity due factor, this should be an equal sign, not a subtraction sign, you get $400,000. That's the present value of the minimum lease payments. And so the present value of the total minimum lease payments is $400,000. So we're going to book this equipment in the accounting records of the lessee on the day that we enter into the lease agreement by debiting the lease equipment, crediting the lease liability for the present value of minimum lease payments, which is $400,000. Also, remember the first payment on this lease occurs on the date that the lessee entered into the lease agreement on January 1st, 2014. So on that date, the lessee is going to cut a check to the lessor for $81,680. Now, so the lessee is going to book that entry by crediting cash $81,680. Now, a portion of that $81,680, specifically $1,563.19, the executory cost of the payment, is, according to the facts of the problem, a prepayment of insurance on the leased asset. So the lessee is going to set that $1,563.19 up in their accounting records as prepaid insurance, and then amortize that to insurance expense over the 12-month period of time. And then the remaining portion of the payment, $80,116.81, that is characterized as a payment of principal and is going to go as a reduction of the lease liability amount. It's considered in full to be a reduction of principal and no interest component because the payment occurs on the first day in which we enter into the lease agreement, so that lease liability has not had an opportunity to incur any interest expense at all. All right, clearing out a little space here, and then we'll continue with the rest of the journal entries. Okay, so here we are at December 31st, 2014. What we've got to do on December 31st, 2014 first is we need to accrue interest on this lease liability. Now, the payment's not going to take place until tomorrow, January 1st, 2015, but we need to go ahead and accrue the interest on the lease liability on December 31st, 2014, because that's the end of our accounting period. So to accrue the interest on it, we take the carrying amount of the lease liability at the beginning of the interest period. The beginning of the interest period, of course, is just January 1st, 2014. Take the carrying amount of the lease liability at the beginning of the interest period and multiply it times the interest rate that we're using here in our present value calculations, which is 8%. That's the lessee's incremental borrowing rate. Okay, carrying amount of the lease liability at the beginning of the interest period is just the amount that we originally credited to the lease liability account, reduced by the amount of this first payment that occurred on January 1st, 2014 that was deemed as a principal payment, which served to reduce the lease liability carrying amount. So the net of those two amounts represents carrying amount, the lease liability beginning of the year. Multiply that times 8%, and we come up with 25,590.66. That's the amount we're going to debit interest expense, credit interest payable. Okay. Another entry that we need to make on December 31st, 2014 is we need to record depreciation expense on the leased asset. So let me clear out some of this markup stuff that I've got. Okay, so we're going to take the amount at which we booked the lease equipment up here, subtract from that, that should be a subtraction sign, not an equal sign. Subtract from that the guaranteed residual value portion. Well, there is no guaranteed residual value here. There is residual value, but it's not guaranteed. So the lessee, when they calculate their depreciation expense, they do not subtract anything there, again, because there's no guaranteed residual value. So the depreciable base of this leased asset from the point of view of the lessee is $400,000. And then the period of time over which the asset is to be depreciated, in general, a lessee depreciates a leased asset over the lease term. The only circumstance in which they don't is if there's a bargain purchase option or the lease transfers title to the lessee at the end of the lease term. In this case, neither one of those are present, so we're going to depreciate this leased asset over the lease term. So 400,000 divided by 6 gives us depreciation expense of $66,667. Debit depreciation expense that amount, credit accumulated depreciation by that amount. Okay, clear out a little space here. Now finally, the last thing that we need to do on December 31st, 2014 is we need to write off the prepaid insurance that we set up here at the beginning of the year when we made our first lease payment. Okay, that prepaid insurance bought us insurance coverage for a 12-month period of time. By the end of the year, December 31st, 2014, that prepaid insurance had expired, so we're simply going to write it off to insurance expense. Credit prepaid insurance, debit insurance expense. Okay, so that takes care of all the entries in 2014. In 2015, on January 1st, 2015, we need to record our second lease payment. Again, the lease payment account is $81,680. Out of that $81,680, $15,630.19 is considered executory cost, and so we're going to debit that to prepaid insurance because that's what we're paying for according to the facts of the problem. Is that $15,633.19 buys us insurance coverage on this piece of piece of equipment. And then the portion of the remaining portion of the payment has to be split between principal and interest. Now, up here in this journal entry, we accrued interest, so we know out of the remaining portion of the payment, $25,590.66 represents interest, and the remaining portion, the $81,680 less the $25,590.66 less the $15,633.19, or $54,526.15, represents the portion of this payment that is characterized as a reduction as principal, and therefore is a reduction of the lease liability amount. So there's the entry that we're going to make in order to record the second lease payment on January 1st, 2015. Debit prepaid insurance $15,633.19, debit interest payable and debit lease liability for 54/5/26/15 with an offsetting credit to cash for the amount of the payment that was made. Okay, at December 31st, 2015, now here we are at December 31st, 2015. We need to prepare an adjusting journal entry to record 2015 depreciation expense. We're going to do exactly the same thing that we did last year. Come up with exactly the same amount. Debit depreciation expense 66,667. Credit accumulated depreciation 66,667. And we need to prepare an adjusting journal entry at 12/31/2015 to write off the insurance expense, the prepaid insurance that we recognized here that has now expired. So debit insurance expense, credit prepaid insurance. We consumed the value of that insurance, and now we need to recognize it as insurance expense. And finally, the last thing that we need to do at the end of 2015 here is we need to accrue interest expense on this lease liability, the amount of interest expense that has accrued up through December 31st, 2015. The way we're going to do it is real similar to the way we did it last year. We're going to take the carrying amount of the lease obligation at the beginning of the year, that's at 1/1/2015, and multiply it times the appropriate interest rate, which is in this case 8%. So the carrying amount of the lease obligation at the beginning of 2015 is the amount that we originally booked for the lease liability here, less the debit to the lease liability account that we made in connection with our first interest payment, less the debit to the lease liability account that we made in connection with our second lease payment. And the result of that calculation is going to give us a carrying amount of that lease obligation at the beginning of 2015 of $265,357. That's the $400,000 less the $80,000 less the $54,000 there. Take that, multiply it times 8%, and the result of that calculation gives you the portion, or the amount of interest rather, that's accrued on this obligation from 1/1/2015 through 12/31/2015, and that's $21,228.56. So we're going to debit interest expense, credit interest payable for that amount.